How do I use P/E ratio in fundamental analysis? Imagine trying to figure out if a stock is a good deal or not. The price-to-earnings ratio is one of the tools that can help you do that. It compares what you pay for a stock to how much money the company makes. This ratio is simple but powerful when used correctly. The P/E ratio is calculated by dividing the current share price by the earnings per share. For example, if a stock costs $50 and the company earns $5 per share, the P/E ratio is 10. This means you are paying $10 for every dollar the company earns. It helps you see if the stock price is high or low compared to the company's earnings. In fundamental analysis, the P/E ratio is used to compare companies. If two companies are in the same industry, a lower P/E might mean the stock is undervalued. A higher P/E could suggest investors expect higher growth in the future. But it is important to remember that different industries have different average P/E ratios. For example, technology stocks often have higher P/E ratios than utility stocks. The P/E ratio also shows what investors expect from a company. A high P/E usually means investors think the company will grow fast. Growth stocks like tech companies often have high P/E ratios because investors believe in their future earnings. Value stocks, which are considered undervalued, tend to have lower P/E ratios. Knowing this can help you decide if a stock matches your risk level and goals. You can find potential investment opportunities by looking at the P/E ratio. If a stock's P/E is lower than its historical average or compared to similar companies, it might be a good buy. But if the P/E is much higher than peers, it could be risky if earnings don't grow as expected. However, the P/E ratio has limits. It does not consider a company's debt, growth rate, or industry cycles. If a company has no earnings or negative profits, the P/E ratio cannot be calculated. Always use the P/E ratio along with other financial measures and qualitative factors for a complete picture. To use the P/E ratio, start by calculating or looking it up for stocks you are interested in. Then compare it to the company's past P/E and to other companies in the same sector. Think about why the P/E is high or low. Could it be due to growth prospects or temporary issues? Use this as a starting point for more detailed research. For building a balanced investment plan, the P/E ratio can guide you to stocks that fit your comfort with risk. If you prefer safer, steady investments, look for stocks with reasonable P/E ratios and stable earnings. If you are willing to take more risks for higher potential returns, consider stocks with higher P/E ratios, but only if you believe their growth will materialize. Remember, the P/E ratio is just one part of the puzzle. Combining it with other analysis methods will give you a clearer view of whether a stock is a good fit for your investment plan. Using this ratio thoughtfully can help you make smarter, more informed decisions in your journey to grow your wealth.